Hi, my name is Hélène Heberlein. Welcome to our episode of Covered Bond Conversation. I'm joined by Cosme de Montpellier from the Covered Bond Analytical team at Fitch. Today we're going to have a brief conversation about the trends and developments in our market. Cosme, to start with the good news, covered bond ratings have a positive momentum. We have been upgrading a growing number of programs since 2022 when the EU Covered Bond Directive was implemented. So tell us, is this a coincidence?
Yes, I think we can talk about a positive momentum, and it's not a coincidence. But just to give a few figures, we upgraded 9 programs last year, 12 programs this year. Some upgrades were directly linked to issuer upgrades or sovereign upgrades. I'm thinking of Cyprus or Portugal. But others were directly linked to the implementation of the Covered Bond Directive. And this is because of the 180-day liquidity rule, which improves the liquidity protection within Covered Bond program, especially in countries which had weak liquidity protection, for instance in Spain or Portugal. So in these countries, we increased our payment continuity uplift to 3 notches in Spain and to 4 or up to 6 notches in Portugal. So we had upgrades of Covered Bond there directly because of the implementation of the Covered Bond Directive. But in other countries where covered bonds were already AAA and where the implementation of the directive also led to better liquidity protection, we increased our payment continuity uplift, for instance in programs in Germany, Denmark or Belgium. And for these programs there's a higher buffer against issue downgrade, so the ratings are even more resilient. However, in terms of the implementation of the directive, it hasn't been consistent across countries. The 180-day liquidity rule has been calculated differently, and sometimes within programs we had different liquidity rules, with the 180-day liquidity only applying to new bonds and not to legacy bonds. So even though the bonds rank pari passu, we look at the weakest liquidity protection in the programs. Finally, what I want to say is there's a lack of transparency in terms of the liquidity rule, how it's calculated, the types of liquid assets which are used to fulfill the rules. And the notable exception for that is Germany. It's the only country where we see better transparency.
Okay, so to summarize, the liquidity buffer requirements of the EU directive has been rating positive, but more disclosure about how it's calculated would be helpful for everyone. Now turning to the less good news in terms of credit risk of the cover pools. Some of the programs we analyze are exposed to commercial real estate, notably in Denmark, in Germany, in Spain. How worried are you about the current downturn in this sector?
So the current downturn mostly affects the US, also Europe, but it's most significant in the US and especially in the office market, which is mostly a floating rate market. Vacancies there are between 12 and 20% depending on regions. It's lower in Europe, where we do see vacancies, especially in offices and retail properties. The ECB published a comment late August regarding the valuations. They're highlighting shortcomings in valuation of CRE properties in Europe, and these properties will be revalued downwards. It is something we expected, and our financial institutions colleague published a comment saying that they expected this, but the revaluation of CRE property alone is unlikely to result in rating downgrade of banks because of retained earnings and precautionary loan loss allowances. So this is already a layer of protection. The banks are unlikely to be downgraded for this risk alone. In addition to this, there are specific protections against low valuation of CRE properties and higher default rates of the loans backed by these properties in cover pools. To name a few of these protections, we have the 60% loan-to-value limit that applies to CRE properties in all cover pools. In Germany, the concept of the mortgage lending value, which is below the market value, so there's a buffer there by construction. We also have very limited US CRE exposure in cover pools. In Germany, I think there's only 2 programs with more than 10% of US commercial real estate exposure. The average is 5%, some have 0%. We have also in cover pools a lot of diversification among property types, and also we tend to have mixed cover pools of commercial and residential properties, so that's another layer of protection, of diversification of the risk. In addition to that, when we look at CRE loans in cover pools, they tend to be loans to SMEs, which may have access to other sources of cash flows than the cash flows derived from the property alone. That's another layer of protection. And last but not least, the over-collateralization buffer within cover bond programs. So typically, there's a lot of buffer between the over-collateralization available and the one supporting the rating. So overall, many mitigants within cover pools against this CRE property downturn.
Okay, so just to summarize, valuation may be lower than reported, and commercial real estate remains a differentiating factor between different programs. However, there are many layers of protection. Okay, now talking about other asset classes and commercial real estate, we are seeing some programs or some dual recourse instruments secured by unusual asset types in the cover bond market. Can you tell us what they are and what challenges you see in the analysis?
Yes, so I'll give you a few examples of this, but we rate cover bond programs backed by auto lease receivables in Switzerland on behalf of EMEA, and we also rate a dual recourse instrument backed by CRE leases in France on behalf of BPCE, the Aval FCT. Generally, in terms of analyzing the credit risk of the underlying assets, this is not a challenge for us. We do have the criteria to analyze these assets. The challenges lie elsewhere. First of all, the liquidity of these assets. Generally, we have poor liquidity, especially if there's only one or a few programs secured by such assets. And this is relevant for us because when we look at programs with maturity mismatches between the cover pool and the cover bonds, we assume that the cover assets will need to be liquidated in order to pay the cover bonds on a timely basis. So if there's little liquidity in the cover assets, it's unlikely that the cover bonds will be paid on a timely basis. There is a mitigant for this, which is the conditional pass-through redemption feature of the bonds, because in those cases, assets do not need to be liquidated to pay the cover bonds. The second challenge that we can see for these programs with non-standard assets would be the treatment of cover bonds in a resolution scenario. Especially for non-bank issuers, cover bonds are unlikely to have a favorable treatment in a resolution, and therefore we would not be able to give a resolution uplift to these programs. That limits the maximum achievable rating of cover bonds in those programs. Last but not least, I should mention the over-collateralization, because these assets are riskier than traditional mortgage loans, and therefore when we assess the over-collateralization for high ratings, it's likely to be much higher than for standard mortgage programs.
Thank you very much, and thanks for joining us today. If you have any questions or would like to continue the discussions, please contact us using the address on screen. Thanks for watching.